Did you hear the big news? United Arab Emirates, UAE, is the most recent country to withdraw from OPEC. And they officially exited the cartel with the wider OPEC alliance. The decision ended the Gulf states' 58-year membership to pursue its own interests and pump more oil independently. And why is this important is what we're going to talk about today. And what the heck is OPEC for those of you guys who are still learning this? This is the podcast for investors in oil and gas. I've been in this world since 2019. I still consider myself quite a newbie of this. But what I tell investors is just start listening to the podcasts, learning the big trends, understanding how things are related. And I think that's where OPEC is a big part of this world. So what is that? And why do people immediately start to have this negative connotation that oil prices are always being manipulated? It's partially true, but it's also too simplistic as that, as OPEC is not just some magic button that sets the prices of oil every morning. It seems that way. But it does not control every barrel of oil out there in the world. And it does not control demand. It does not control how much China, India, Europe, or United States consumes. But OPEC does matter. And if you're an investor, it's important to understand how these things impact the global oil energy supply. Because even if you are just investing in some plots in Texas or California or Colorado or America, all this really impacts how your deal is underwritten. And you should check how your deal is underwritten, because oil prices are not just what happens at the gas pump. Oil prices also impacts other things in your portfolios, such as food, plastics, fertilizer, transportation, and how companies spend their money and expand. So let's break this down. So what is OPEC? How does it influence oil prices, and why does the UAE want it out of this thing? So OPEC stands for the Organization of Petroleum Exporting Countries. At its core, OPEC is a group of oil-producing countries that coordinate around oil production. And that's the key word. And if you come in the beginning, it is a bit of a cartel, and a cartel in maybe a bad way. They're not just setting the retail price of gasoline in Hawaii, California, Texas, or New York. They're definitely not setting what Costco is charging at the pump. But what they're trying to do is influence the amount of crude oil supplied into the global market. And that's their indirect way that they're impacting prices. Again, economics 101. Supply and demand is somewhat consistent, but here a keyword is the supply is what they impact, and thus they impact pricing pretty heavily. So oil is a global commodity, just like coffee, just like cotton, just orange juice. It's probably one of the most used and greatly impacting other sectors commodity. And a barrel that comes out of the Middle East competes with the same barrel that's produced in the United States, Brazil, elsewhere. Even though we've had past podcasts talking about the difference between light and heavy crude, for the most part, it's a global energy trade. So when they say that they're going to restrict supply, what they're saying is they're going to produce less so they can tighten supply. And when they say we're going to produce more, they're going to loosen supply, increasing the amount of oil that's out there, which you guys obviously understand how that works. When you increase supply, that's when the prices go down. So in real life, this is messy, but it's been in like this for quite some time, for decades. A country can announce a higher production target. It's like how the Fed says, hey, we're going to keep the interest rates, the Fed rate at this rate. But they may also do other things like buy back bonds, right? Other methods of quantitative easing or quantitative tightening. So moving back over to the oil side, right? That doesn't mean that the oil instantly appears or disappears. It still has to be produced and it has to be transported. And as we talked about earlier, we've gotten a little bit more granular with how you drill for oil, we turn it back on. It takes a lot of money to turn it on. You can't really turn it off, the thing, right? It's not like a faucet, right? And that same is carried over to just because you're calling for less target of oil doesn't mean you can just turn off those suckers right away. And this is why oil is not just a commodity story. It's everything in the economy, logistics, geopolitics, and it's like a financial plumbing story. Before we move on, there's also talks of OPEC Plus. They're not exactly the same thing. OPEC is the original OGs, the cartel of member countries. OPEC Plus is the expanding of alliance that also includes other producing countries, most notably Russia. And why does that matter? OPEC is alone very powerful, but OPEC Plus is broader. It represents a coordinated supply goal. When OPEC Plus meets, the market pays attention because these countries can influence the balance between global supply and demand. Whereas when you just have OPEC doing something, you usually have other people on the other axis. Ooh, maybe I shouldn't say that word, but China and Russia doing kind of the opposite, maybe playing the black market in that it's not really too black hat, black market, but they're always doing things. So when you have OPEC Plus, you include those guys in this, and it becomes a stabilized front where you can see where the market is going. So again, if the market thinks that supply will tighten, prices move up because the actual shortage shows up. If the market thinks the demand is weakening, prices can move down even before storage tanks are full. And there's storage tanks and there's slack in the system. And there's all these literally oil and tankers that operate like a pipeline. So there's a big delay effect that once you make a call for a lower target, it doesn't really impact things right away. We saw how this worked with the Iran Strait of Hormuz plug up happened. I think it was for a few months there, but it's not like things all came to a halt, right? There was a lot of supply. And then if we went longer, United States probably would have had to export more oil to pick up a lot of that slack so things wouldn't have gotten dire. But one thing I'll point out, like when OPEC Plus announces production increases, doesn't necessarily mean that it can actually happen because of different constraints like infrastructure, geopolitical conflicts. Things come up and it's just a target, right? And this is where the market may treat these as symbolic, and which is that I'll highlight that important word. It's symbolic. It's a quota increase is not the same thing as barrels delivered. Thus, supply and demand, what actually people pay too. On a side note, in May of 2026, 7 OPEC plus countries announced a almost $200,000 barrel per day production adjustment for June, saying that it was tied to the commitment to supply oil market. And this is the time when things were getting rough with the Strait of Hormuz all plugged up. But doesn't necessarily mean that it happens, right? Not saying it's necessary. Hey, we're going to come help you guys out there. We're going to send all these things. But yeah, we're still waiting on that to happen. The next thing I wanted to talk about is the simplest way to think about oil prices. Oil prices move based on the tension between demand and supply. And what we're talking about earlier was more like targets, this extraneous thing of, hey, yeah, I'll try and pump some more oil. We'll turn it up the heat a little bit. So demand, again, is how much oil the world wants to use. And supply is how much the oil in the world can produce and deliver. And that last word matters, right? Like I said, it's not just a target, it's actually what gets delivered. So you can have oil in the ground, but you can't extract it, transport it, ship it, insure it, refine it, get it to where you need to be delivered. And this is where they say the world is moving to renewables, so oil must go down. But that's obviously not happening. I've definitely seen a lot of statistics out there where it is a small fraction of what is used. Green energy is a fraction of what traditional oil, darker energy does out there. And, one thing I've done in the past is emulate what the big players do. Your Blackstones, your Warren Buffetts, Berkshire Hathaway, and then, what those big players, KKR, will do. And if you look at their energy funds, did this back, I think, late 2025. So it might have changed, probably didn't. But if you look at what they're investing in, yeah, they'll go on press and say, yeah, we love to do solar and wind. But when you look at their portfolio, it's something very different. So ask your own AI, get your own data. But if with the research that I did, they're not quite putting their money where their mouth is. In fact, they're putting their money back in oil and natural gas because that is actually what moves the needle forward. Sure, there's a lot of exploration with green renewables, but it doesn't seem to be moving the needle anytime soon on actual usage and demand. And the truth is, it's not just oil. Petrochemicals go into plastics, medical supplies, industrial materials, all these types of products that you're not going to be moving away from. So going back to the whole supply-demand thing, here's another important concept, spare capacity. This means how much extra oil one can be brought online relatively quickly. Now, when the world has a lot of spare capacity, oil markets are less fragile. We saw this happen. It got tested here recently with the war of Iran, where there were about 2 or 3 months of kind of draining those supplies and people had moved things here and there. And yeah, some ships got through the blockade, through black market, but there is some slack there. It is somewhat, it's not super fragile, but it's certainly open to disruption. So as an investor, these are the types of geopolitical risks that and wars that you have to be thinking of. If you're an investor, when there's wars and cost of oil skyrockets, you can be on the winning end of that. But anyway, don't want to necessarily benefit at other people's expense, right? Wars suck, people die, it's terrible, but they happen. And as an investor, you need to understand that you got to play both sides of it and somewhat hedge your portfolio, right? Because when those terrible things are happening, your AI stocks, which is pretty much all of S&P 500 these days, will go down, right? When you face those types of headwinds from an economy's point of view. So how does this connect with today's oil trends than people think? So this is where demand is coming from businesses, countries, people who want to buy things. Now, even with AI creating such a need for energy, and one of the big trends I see in the next 10 years, putting a more emphasis on oil and gas and energy in demand and creating an even higher baseline for power, many parts of the world still see natural gas and oil-related infrastructure and traditional energy systems as required. And then next thing is supply is harder than you think. You can't just create a target. Doesn't necessarily mean it gets brought online, right? You've got to have the fortitude to turn on your well, to know that for the next 6 months to a few years, you absolutely cannot turn that thing off. It'd be stupid, right? Because to turn it on, you put in $250,000 to $500,000 to turn it on, and turn it off, you can't really turn it back on if you turn it off, is the idea. It's a dynamic in what's actually going on granularly with people's head on the ground. And when you're diversified in a bunch of oil wells, this is what you think of. Hopefully that's why you try to diversify into dozens and dozens of these wells, so you don't necessarily worry about one of them going online and then you need to turn it off. But you guys can understand how the dynamics of this investment works. So I think the big takeaway here is like OPEC obviously influences things, but doesn't control everything. With UAE leaving OPEC, I think what they're trying to do here, and they're not the first major country to leave, but they want to break apart and they want to set their own targets, whether they sell their oil for less, but they obviously are leaving because they feel like they can produce more and make more money and leave the cartel, leave the safety of that group. Obviously, it makes OPEC less of importance because they just lost a big player there. I don't know. It depends on what side of the ship you're on. This is not a political type of podcast where you're saying free market, free enterprise, reigns supreme. Frankly, I don't care. I'm just telling you how the world works with OPEC and its players. And I think the energy is still a real asset class out there. But it also, as an investor, your operators matter, how the deal is structured, your tax treatment matters for the individuals out there, which is a big part of investing in this sector. But hopefully today's discussion gave you a little bit more of maybe I pushed you a little bit more jaded in what the whole OPEC does and how they set targets and how supply and demand works. But maybe take it with a grain of salt. There was a little bit of my own intuition into here. But that's what OPEC is, and it is a big player in today's oil markets. And when you hear these types of headlines, understand what it's impacting and still take it with a grain of salt, like I mentioned. But thanks for listening to today's podcast. If you haven't yet, leave us a review. And if there's other questions that pop up, put it in, send it over, lane@thewealthelevator.com. And thank you all for listening. Bye.